We have gold prices going up and people still hitting in that thesis saying, well, but the miners won't work. And I don't know who's supporting these views historically because they're not throughout history we don't see that. Gold is not going to go up in a straight line. Sorry to break that news to most of you, but that's just not going to be the case. And so the miners, they're going to go through a volatile period. But do I think the share prices and gold prices will be higher 10 years from now? Yeah, I believe so. And so if that's the case, some of these opportunities look extremely asymmetric.
In August 2024, gold prices reached record highs, surpassing $2,500. Despite this, UBS analysts believe the gold market is not overvalued. The analysts consider macroeconomic factors, investor positioning, and market dynamics to conclude that there is potential for further price increases. The mid-tier and junior gold miners in this sector's sweet spot for upside potential just finished reporting spectacular quarterly results. Fueled by dazzling record gold prices and lower mining costs, smaller gold miners' unit earnings skyrocketed to their highest levels ever. Seasoned analyst Tavi Costa from Crescat Capital ironically notes that his millennial status often clashes with his boomer-like enthusiasm for gold. He notes ongoing skepticism about miners in the face of rising gold prices. Tavi further predicts that while the path may be volatile, both share and gold prices will be significantly higher in the next decade. Despite the challenges, Tavi underscores that silver will rise if the gold bull market takes off, making silver miners a compelling investment. He highlights silver's leverage to gold, citing his recent acquisition of a significant silver mine as a strategic move during a depressed market. In the 2000s, when gold returned 657%, silver gained 1,132%. However, silver currently sits at just under $30 an ounce, but there is an increasing belief that the price could reach $100 in the next couple of years. The projected price growth is good news for companies such as Andean Silver, which recently purchased a silver mine in Chile and is working towards bringing the project out of care and maintenance in the coming year. While supporting his current thesis, Tavi predicts that the domino effect began with gold and energy. He advises patience, warning against short-term market reactions, and argues that unmet expectations only strengthen his conviction to act on these trends. Now, we present the clips of Tavi Costa's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I get called a boomer all the time, although I'm a millennial, and which is funny, but because I love gold, and it's not that I just love gold. I just see that as an indication of other potential trends that could be unleashed because of the gold price. And I think there are a few scenarios, but I find that those scenarios are significantly smaller than the amount of chances we have here of entering a gold secular bull market. And I have to wear that hat for the next 5 to 10 years and extrapolate that as if that's the case, then what happens? And silver has to come to mind. I think that owning a very significant silver miner today, which is extremely difficult, is going to be a very interesting investment for the following years. But that's my opinion. And the reason for that is because you want to find leverage to even silver prices that seem to have massive leverage to gold itself. And so I've been really focused on that. I mean, we did an acquisition of the 7th largest silver mine in the world recently. You don't do these things in a very bullish environment for silver. You do these things when things are really, depressed, which was the case not too long ago. But the environment still is that way. We have gold prices going up and people still hitting in that thesis saying, well, but the miners won't work. And I don't know who's supporting these views historically because they're not. Throughout history, we don't see that. I'm not going to trust the new guy. There's always a new guy in markets that want to, claim the fame of knowing everything about I put all my faith on history. I do a lot of analytical work and look at back in history and historical trends and correlations and long-term ideas that worked in the past. And the truth is that there's nothing similar to what we have today, meaning there's nothing equal. There's things that are similar. And so it is in a way unique. But I think it's unique from the standpoint of being more extreme than prior times, which means it makes me more bullish, not less, in the things that I believe, such as gold, emerging markets, miners, energy, agricultural commodities, you name it. FX of other fiat currencies versus the dollar. Yeah, I think the dominoes are starting to fall. And it started with the gold and energy, but there's a lot more to go here. And so, like I said, they're not going to happen all at once. But once they will probably be somewhat linked to each other, as we tend to see throughout the course of a long-term period of time. But a lot of times we get caught up in these, 1 to 2 month periods, and gold went up and emerging markets didn't. So, this thesis is not right, and it's not true at all. These things, they take time to develop. If something hasn't worked yet, it actually gives me more conviction that I should act on it. And so, yeah, look, I've done a lot of work on this, and I could be wrong like anybody else. But conviction is a big part of this, because we need to have that in order to act accordingly and add to your positions when you have those shakeout moments. And we will have plenty of those in the next 5 to 10 years. Gold is not going to go up on a straight line. Sorry to break that news to most of you, but that's just not going to be the case. And so the miners, they're going to go through a volatile period. But do I think the share prices and gold prices will be higher 10 years from now? Yeah, I believe so. And so if that's the case, some of these opportunities look extremely asymmetric.
During the interview, Tavi Costa noted that the gold to NASDAQ ratio surged 13-fold in the early 2000s due to extreme overvaluations and strong gold performance. Costa emphasizes that current high valuations might not be seen as a bubble now, but history could prove otherwise. Since the start of this century, gold has appreciated 610%, over which time the NASDAQ 100 and S&P 500 have total returns of 441% and 410% respectively. Gold prices surged following Federal Reserve Chair Jerome Powell's pivotal speech at the Jackson Hole Symposium, with the precious metal gaining 1% and closing the week up 0.17%. Powell's remarks hinted strongly at an imminent interest rate cut, potentially as soon as September, driving a retreat in both the U.S. dollar and Treasury yields. Based on fundamentals, Tavi argues that the U.S. can't sustain restrictive monetary policies due to high debt and interest payments. He predicts rate cuts and potential inflation reacceleration, significantly impacting the dollar and FX markets. Let's get back to the interview.
If you look at the gold to NASDAQ ratio in the early 2000s, I think it went up about 13-fold as well, which I think today would be unthinkable. Now, if I tell you that the gold to NASDAQ ratio would go up 13 times in the next, call it, decade, I don't think a lot of people would agree with me here. And so, and the reasons for that, again, is because something got really frothy valuation-wise, and the deflation environment of those valuations, certainly was a huge factor. And the second factor was that gold outperformed extremely well too. And so it's a combination of things. And I think the main reasons for this is, I had a good chart of the CAPE ratio, which I like the CAPE ratio, the cyclically adjusted PE ratio, because it gives you a good perspective of history. And we often do in, hindsight analysis. In other words, we look back in history and we say, oh, well, obviously 1929 was a bubble. Obviously the tech bubble was a bubble. But then we looked at valuations extremely comparable with those peak periods in markets, and we say, nope, it's not a bubble today. But then in 5 years from now, we'll look back and say that was a bubble? I mean, that just seems a little bit evident in terms of the signs that things are extremely expensive right now. I think that shows that the U.S. cannot afford a restrictive monetary policy any longer. And not only that, is a completely inconsistency of monetary policy relative to the magnitude of the debt. And an unpopular view is that, yes, the problem with leverage in the U.S. is extremely manageable. The only issue that is not manageable is the interest payment relative to GDP, in which is currently at levels that can create a lot of problems already. And so it is likely to be, making the Fed job extremely difficult moving forward. And this whole, obsession we all have with inflation and labor markets is sort of meaningless. It doesn't really matter anymore because interest rates need to be reduced regardless. And so I can even point to a position in the markets that we may see where interest rates may be reduced by the Federal Reserve. And at the same time, we may see actually inflation reaccelerating and the Fed being forced to ignore that. And it's not like they're being ignored. I think that can be rephrased. Maybe that's the part of the plan. I think a lot of people would agree with that. Inflating our way out of that problem is one of the ways out of this situation. But that research was remarkable because a lot of people think that other central banks are in a very difficult position, and they are, but they have been managing their service debt ratio much better than the US. And so as the US starts to sort of go back to normal, or in other words, normalize its monetary policy relative to where the debt problem really is, I believe that that's likely to have major impacts in FX. And to add to that point, when you think about it, I've always been a very bullish on hard assets. I've always come out in your show and talked about hard assets, commodities, gold, but I've never talked about being bullish on fiat currencies relative to the dollar. And that differential of interest rate policy relative to where GDP is and the cost to service the debt is just so out of whack with the rest of the world that I do think that the policy, the risk for the US moving more rather than less relative to other central banks is significant. I think it's going to have a meaningful impact in FX and also the dollar itself. And pay attention to days when NASDAQ is declining and the dollar is supposed to be rallying, but it's not rallying. And so some investors, really savvy investors, are starting to pick that up. And, I do think that this is going to become extremely meaningful in the following 1 to 2 years. I mean, this is already a big problem. And even in Jackson Hole, I think it's likely to be a big discussion across most policymakers.
While the outlook for gold remains positive, traders should be prepared for potential volatility. The buy the rumor, sell the fact scenario could lead to short-term fluctuations, especially if the September rate decision aligns closely with current market expectations. How will the potential rise in precious metals and miners' prices impact your investment strategies over the next few years? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.